market is very complex, but understanding these complexities makes the market very simple. So now, in today's lesson, one of the core issues that will be addressed are one of the complexities of the market, which is the buyer's advantage. A lot of traders, even professional traders, novice traders, and intermediate traders, they are unaware of this fact. Which fact? The buyer's advantage. We need to know that the market is primarily driven by emotions, which are fear and greed. These principal emotions move the market, not just mere facts. So now, in today's lesson, we are going to be delving deep into the buyer's advantage. To begin with, let us imagine a case scenario. Which of these forces are stronger? The force that has a stock of a particular product on ground in bulk, in mass, and it sells to those that are going to buy at distributor's price and resell at a retail price. Which of these forces are stronger? If you are not new to business, you should know that the strongest force is the force that has a particular product in bulk, because such a force must always have such a product on ground at all times, because it sells in bulk and it has to have them in bulk. It has to have the raw materials. It has to be always in the market. While the other force that buys at distributor price and sells in retail, it might decide not to sell the product. It might decide to get another product. But the force that always has to have in bulk is the strongest force, and that is the forces of the buyers in the market. So now, let us go to the weekly chart and see some things. Or let's go to the monthly. If you go to the monthly chart and you scroll way back, what are you going to see? Let's just go to one of the emerging markets like the Trump USD. What are you going to see when you go to the bottom of the chart? Just go to the weekly. What you are going to see is that the market always begins from a particular low, because buyers are strongest there and they are attempting to move the currency up. This is an emerging market, and you can see the market started with fear, which are sellers, but what happened? You can see the buyers pumping it up. So these are the ones that always have to have the product on ground, the buyers. That is the buyer's advantage just in business. And you need to know that the rules that apply in business, those are the same rules that apply in the forex market. Because now in business, those that have a particular product in bulk, they always determine the price. Tomorrow, they can tell the distributor that a particular price is already increased with $5. There is a 10-cent increment. There is a 20-cent increment. In fact, there is a $100 increment. It is all at the disposition of the ones that have the particular product in bulk. Those are the bulk buyers. While these that sell at the retail, all the profit they will make are determined by the buyers. So just as it is in business, that is how it is in the market. So right here, I'm opening the Trump coin because it is an emerging market. It is a new market. It was just introduced about a few months ago, a particular cryptocurrency. So that is the foundation of where we are going to begin to analyze the facts. The illusion of rationality. Markets are often driven by emotions, not just cold, hard facts. Fear and greed are dominant forces. Recognizing these emotions in market behavior can help identify opportunities. So now, which human behaviors are we talking about? We are talking about greed. Humans are more greedy than they are more fearful. That is why you are going to see a particular trader trading without stop loss. If humans are more fearful than they are greedy, you won't see anybody trading without a stop loss, because we know in the market it is uncertain and nothing can happen. So now let's just say, for instance, a trader is taking a position from this particular swing and he wants price to come down. Just out of greed, let us say is meant to target a 1 to 5 RR or so. Out of greed, he might not even use a take profit and a stop loss, because he just expects price to continue tanking down. So that is how you need to understand how the human mind works, that humans are more greedy than they are fearful. So recognizing these emotions in market behavior can help identify opportunity. However, we want to identify what emotions where humans are being greedy. However, you need to be technical about this, because as a trader you need to be fearful when others are greedy, and you need to be greedy when others are fearful. So now, decoding market sentiments. To be able to decode market sentiments and find good opportunities, you need to be able to have a critical understanding of technical analysis, which are trends and turning points in the market. You need to be able to identify key support and resistance level, and you need to be able to observe the order flow. Those are the flow of capital in the market and how the market moves. So if you are able to do all this, finding opportunities will be very easy. So now we need to be aware of psychological traps. We need to avoid confirmation bias, market sentiments, and we need to be as objective as possible. Because you need to know that the fact that a particular indicator signifies that a market will go up or go down, that's the confirmation bias, but you must still be flexible, because the market can do anything. And you should be able to recognize and manage your emotions. Fear and greed, we cannot run away from them. These are emotions that make us humans. Overconfidence, just because you have just because you are in a winning streak, you have 2 wins, 3 wins in a row, you must not be overconfident. You must still remain a student of the market. So now, the buyer's advantage, you need to be able to use the knowledge of the market psychology that we have just discussed to your advantage, and you should know that buy positions are always stronger. Learn to identify buy opportunities based on what emotional shift in the market, because once you see an engulfing pattern, once you see a support broken to form a stronger support, you need to know that there is an emotional shift in the market, and you must know how to capitalize on the market volatility. We have various strategies on this. You must not employ all strategies. Just and always choose a strategy that fits your personality and a strategy that you understand best. So now we are going to take real world examples to show the buyer's dominance and the buyer's advantage. So right here, as you can see the spread right here, we have the spread right in front of us. You cannot trade the market without spread. You cannot run away from the spread. Even if you use a broker that offers a zero spread, I can bet you that at the market close, or whenever there is a big news release, the spread would always and always form. So you don't have any reason to deceive yourself. So we have the bid price and the ask price. The bid price is the price that the buyer is willing to pay, and it is the first price in the pay. So now where is it? We are going to check it, and the ask price is the price that a seller is willing to accept, and it is in the second. So right here we have the bid, which is down, and we have the asking price, which is up. So you can see that the bid price is always lower than the asking price. So this alone is enough evidence to showcase the dominance, to showcase the leverage, and to showcase the power that the buyer has in the market. You can go and check other pairs, it is there. You can see, you can go and check cryptocurrencies, it is there. So These are secrets that will never be revealed to you, and you learn the hard way if you must. You can see this is the bid, this is the ask. So just seeing this, we can decipher the fact that the buyers are always standing strong. So let us take an analogy. For instance, let me say that you took your entry in this particular zone here, in the 1 minute, this particular swing, I marked it in this blue line, and price is rallying down. Once the market opens on Monday and the buyers just wish to increase the price they will sell to the sellers, I bet you they will take you out if your stop loss is here. Even if your stop loss is here, if the spread widens more, because currently the spread is about how many pips? The spread is about 4 pips. So if the spread widens more, about 10 pips, sometimes it can even widen as much as 30 pips, they will take you out if you are a seller. But a buyer, wherever you set your stop loss, it remains intact, because the ask and bid price is always in the particular place where price is forming. You can see this is where price is forming. But you can see the buyers, where did they put the amount they want to sell to sellers? Here. So this is a market secret that no one would ever want traders to know. You can see where they put it. And when their news release, in fact, the spread can open as much as 50 pips. But as a buyer, whichever position you hold and you are trading with a good broker, your positions always stand strong. Let's just go to Euro USD and take more examples. So now, for instance, in fact, this is a picture perfect example. So let us say you enter on this swing, you can see an engulfing candle in the 1 minute. Let's say you're a scalper and you take your position here and you put your stop loss here in this particular blue line. You can see price is still within your range, but the spread would have taken you out. If you had put a trade here, whichever lot size you are using, the spread would have taken you out, because the buyers have already increased their price. And who are the ones that are always playing with the spread? The market makers, the hedge funds. You can see it here. So this is a real life example we have taken here in regards to the buyer's advantage. And all these are driven by emotion. So as a human, let me ask you, let us say you are locked in a cave with a saber-tooth tiger and you have an axe. Out of fear, are you just going to allow the saber-tooth tiger eat you up? Or out of hope, are you going to use your axe to fight for your life? Humans are more hopeful than they are fearful. So you are always going to try your best with your asks to take down the saber-tooth tiger. That is why hope is a powerful emotion that drives the market as well. So from a business perspective and from a perspective of the emotions that drive the market, we can see how these things shape the reality of the market. Plan your trade your plan, and most importantly, manage your risk and emotions. Do the needful you need to do with this information. All is left in your choice, and I wish you all a peaceful trading journey ahead. If you find this useful, like, share, subscribe, and follow for more.